What's up, Gould Miners? Today we welcome Charles Seaman to the program. Charles is the managing partner at Cashflow Champs, a multifamily investment group focusing heavily on the Sunbelt and Southeast U.S. markets. With over $250 million worth of transactions under his belt and over 1,400 units under management, Charles has a wealth of knowledge that he brings to the table, and he puts it on full display in this episode. We kick off the episode by diving deep into the current state of the market, especially the multifamily sector, and why the multifamily sector might not be performing as well as some people might think. Later on in the episode, Charles discusses some of the setbacks and the challenges that he's experienced with some of his recent transactions and the lessons that he's learned from those setbacks that any investor could benefit from learning. Finally, Charles and I spend a good amount of time at the end of the episode talking about some of the clues in our current environment that lead Charles to believe that there are a tremendous amount of opportunities coming up in the next 6 to 12 months. This is an incredibly informative episode, especially if you're thinking about how you could take advantage of some of the upcoming opportunities in the current market that we're in with all the distress that we're experiencing. This is an episode to listen to for sure. So without further ado, everyone, let's welcome to the program, Charles Seaman.
The Gould Mine Podcast.
Charles, welcome to the Gould Mine.
Danny, thanks for having me. It's a pleasure.
Yeah, man, I'm excited to chat, and you've got quite an interesting background here. You've been in the commercial real estate game for well over a decade, and you're a big multifamily guy, right? So obviously, I think the multifamily sector right now is going through some changes, and we're seeing, a little distress in the market. I think that, or in the sector, I should say. I think that it's more resistant than a lot of the other commercial real estate asset classes. But at the same time, I do believe that values and cash flows, all that has been impacted recently by all of the rate fluctuation, right? So what's going on right now in the market? What are you seeing in real time? And what have you found to be true, in this cycle, and what's kind of like noise and kind of myth?
Great questions. So the answer I'm going to give will probably vary a little bit from some of my counterparts. And I agree with you that multifamily is very resilient. At the end of the day, housing is a necessity. It's something we will need. There's a shortage of housing, specifically affordable housing. So there's certainly a need. Nobody's denying that. Valuations have definitely taken a hit over the last 3 years. Specifically in the Sunbelt region, property values are down 25 to 30% from where they were in mid-2022. So that's a pretty good hit. In other parts of the country, they are down a good bit as well. Not quite as much, but it's very rare that you're going to find anywhere in the country that multifamily is not at least 10 to 15% less valuable now than it was 3 years ago. And there's probably a lot more distress than people want to admit. But I think that's also where the opportunities come in. And I think that you're going to see, there's a lot of groups that have been hanging on because, one, for their own track record, two, for their investors. And quite frankly, there's a lot of lenders that are doing the same thing because there's been, something in the industry we call extend and pretend. And a lot of lenders who have had maturing loans over the past year or two have extended them. And the reason for that is because a lot of these groups are debt funds. So similar to a lot of the syndicators or a lot of the groups that are purchasing property, they went out there and they raised capital from their investors, and they don't want to deliver bad news. They don't want to tell them, look, we raised $100 million, we funded 10 loans, and 7 of those loans are going to fail. So they've been trying to find ways to work with borrowers. And let me be clear, that's not necessarily a bad thing. I think it's something that both sides have a little give and take, and it's kind of led to the market taking longer to adjust than it needs to. So my personal opinion is that we haven't hit the bottom of the market yet. I think we're still probably another 6 to 12 months away from that, but we're getting there. I think there are some transactions that are starting to fail. I think that's a necessity. And, I'd like to say that we'll see more of them fail. And you might think that sounds strange, which it does, but I think you need that to really reset the market and bring values back to where they make sense. I don't think you'll see enough of that Obviously 25 to 30% less than 3 years ago is a big hit. But I think things were so inflated at that point that even 25 to 30% is only a little bit off the surface of what they need to be, in my opinion. There's definitely a value. I think you are about to see a lot of money come back in the market. A lot of it's on the sidelines, kind of wait to see what's happening with some of the recent policy changes we've had. But there's a lot of groups that want to get out there and start doing deals again. So in the next 6 months or so, you'll probably see more of that. There has been an uptick in transaction volume, so I expect that to continue throughout 2025. And eventually, at some point, that'll form a bottom of the market, and we'll start rounding the corner the other way.
Yeah, I absolutely agree with you. I mean, I think everything you just said is very true from what I'm seeing as well. And you said extend and pretend. Is that like the cousin to delay and pray? Are we? You're speaking the same language, I think, right? It's
same language. I would say yes.
Yeah. No, I at some point though, Charles, right? And this is a conversation I've had with operators, and I think I've had it like at least a dozen times on this podcast in like the last year. Is everyone's just kind of puzzled right now. It's like we expected the carnage to be here already, right? Like the carnage was supposed to be here like a year and a half ago, and it just keeps like we're like kind of seeing it, but not really. You're and definitely not anywhere near to the degree that we expected it to. So does that all come crashing down at some point, or are the banks just not going to let it happen?
It's a great question. And for the last 3 years, I've been saying that we're going to have a crash. And I guess you could argue that 25 to 30% is a crash. So maybe we have 100% in small increments. So the answer I'd say to that question is I think to some extent the banks aren't going to let it happen all at once. As much as many of us, myself included, would like for it to happen that way, it's got to be slow and gradual. And if we go back to 2008, if you really look at it, most commercial real estate values didn't bottom out to like 2011, 2012. So even though the crisis started in 2008, we didn't see the bottom come right away. It took time. And what I tell people, I guess history is a good lesson in that regard because it took 3 to 4 years, and that's about where we are now. So, I think the lesson there is that I always tell people, if you think of stocks as like a sailboat because they're nimble and you can get in and out of them, you should think of commercial real estate kind of like the Titanic, where it's not nimble. It's slow. It's gradual. It takes time. So stocks are getting the information in real time, right? So if you haven't been in a market, people are reacting right away. They're getting upset. But they're not doing that in commercial real estate because in the best case scenario, it's taking months for them to see that. And many times it's taking years. And the reason for that is because whenever we're looking at sales comps, with the sales comps, the thing is they're always in the past. So It's great because it shows you what's there. What it doesn't show you is what's on the contract that hasn't closed yet. And that's where sometimes it gets very challenging.
I could not agree more. Now, I mean, the biggest issue here in the market right now is the debt. I think what we're seeing right now is bad debt being placed on properties 5 years ago, or 7 years ago. And now sponsors are either paying the price or faced with the reality of having to pay the price. So what lessons can be learned at this point? And I know that you've talked about debt structure as being the number one risk factor, even beforehand. So,
it's funny when you say the greatest one. Yes, I guess it would be all the short-term floating rate debt that was used in the industry. But I think there's a lot of close seconds. So I would say it might be the greatest one, but it might just be by a hair. It was kind of a perfect storm of things. And I'll talk about kind of my perception where I see all the challenges and then also some of the lessons learned. So the challenges, yes, one was short-term floating rate debt. And I'll use myself as an example because I had 4 deals with short-term floating rate debt. And I hate short-term floating rate debt. It's something I've never been a fan of. And in hindsight, I wish that I had stuck to my own rule because I did. I've never really seen anything good come from it. And, when it works, it's great, right? Because, you get in there, cap rates compressing, prices are going up. Maybe you went in there, did some type of value add, they gave you CapEx money. Great. The challenge is none of us have a crystal ball. We can't predict the exact day the market's going to roll over.
Yep.
So whenever you have floating rate debt, it's always kind of subjected to the mercy of the market and short-term metals. Another thing that's really hurt has been rising costs. And that's obviously hurt all of us just in life, not even in real estate or business, but inflation has been a real thing the last couple of years. And in commercial real estate, multifamily specifically, it's been very real. Repairs and maintenance are up, labor's up, just about everything's up. Insurance has been an absolute killer. So insurance, I would say, is actually a very close second to interest rates and bad debt because insurance has went insane. Now, the insurance market is finally starting to level off after the last 2.5 years where it was insane. When I say insane, there are some properties that are probably underwater solely due to insurance because it's really ballooned. We had properties, I'll give you one example. It was a 104-unit property in Georgia that the premium was $43,000 a year in 2022. It ballooned to like $110,000 in 2023. There's no way we could have planned for that because the market itself had a major shift. So that was something to think about. There's also been a lot of challenges with people struggling. A lot of the properties that I've done in the past have been C-class properties. That means you're dealing with a lower income demographic from the tenant side. And a lot of these people are affected. The economy slowed down, even though we're not technically in a recession. There's a lot of people in that demographic that if you were to ask them how they're doing, they're hurting. Right. And maybe they hadn't been laid off, but maybe they were working a 40-hour-a-week job and now they're working 30 or 35 hours. And you might say, oh, what difference does 5 or 10 hours a week make? Well, for a demographic who's barely getting by on 40 hours a week, it makes a huge difference. It's the difference between them paying the rent and them not paying the rent. So there's been a lot of delinquency, a lot of challenges collecting. And it's really been a multitude of factors, kind of a perfect storm of things that have come together to allow for this. So what lessons to be learned? Kind of getting back to the original question. Well, yeah, the first thing I would say, and I'm going to paste this to my forehead so I never violate this rule again. Long-term fixed rate debt. Use long-term fixed rate debt. Yes, it's boring, but boring is good in real estate. You want it to be boring. If real estate gets too exciting, there's a good chance you're doing something wrong. Buy a property with long-term fixed rate debt. You know what you're getting, and make sure that it makes sense with that debt that you have. Yeah. Second thing I would say is always keep more cash on hand than you think you need. And yes, it could be at the property level, but I would also tell you it's on the personal level. Because when deals go wrong, you're probably going to run out of cash at the property level. Trust me, I don't. It's happened on a few deals. And you need to start feeding these deals personally if they're going to survive. So always make sure that you have more cash than you think. Some people think, oh, I want to place every last dollar to work, and that sounds great. The problem there is that when something goes wrong, you don't have any cash to protect the investments you have. So keep cash available. Cash is very important. And 3, the other lesson I would tell you is a lot of people in our industry say timing doesn't matter. Well, I'm going to agree with you if your intention is to buy a piece of property and hold it for 30 years. Then you're absolutely right. Timing doesn't matter. Because you could buy the worst property in the worst area of America, and if you hold it for 30 years, I almost guarantee you it's got to be worth substantially more than whenever you bought it. I'm not going to tell you that in 3 to 5 years. So if you're buying with the 3 to 5 year old, you need to, 1, understand where we are in the market cycles, and 2, respect it. Think of the market cycle like a tidal wave. So you're either riding with the wave or against the wave. And from experience, I would tell you, it's a lot more fun riding with the wave. So, just ask anybody who bought in 21 or 22, 3 to 5 year holds, if your valuation is down 25 to 30%, even if you did increase the net operating income substantially, there's a good chance your valuation is still down because cap rates have decompressed a substantial amount.
So when it comes, for example, Charles, like let's actually go through some of your properties, right? So I know that you're focused heavily on the Sun Belt, right? And like the Southeast markets, yes? Yep. So now the Sun Belt, you're saying, has gone through, this dip. What are the things that you're looking for right now in an investment, right? In those regions?
Great question. So for me personally, the biggest shift that I'm probably going to make personally is to go to a better class of property going forward. Okay. Going forward, I don't want to be doing C class unless there's a really exceptional value. And when I say exceptional, I'm thinking like 50 cents on the dollar type discount where it's like, okay, it's a no-brainer, regardless of what happens, you can't lose. I want to be focusing on A and B type properties going forward because I want a better tenant demographic. I want more security. To be honest, I'm willing to take a lower return in exchange for that because I think it's actually a smarter move, at least for me personally. Mm-hmm. With C class, I'm very concerned in a lot of markets that the incomes aren't there. And the challenge I see is really a long-term issue. I don't think it's something that's going to resolve itself as the market rebounds. Yes, the real estate market will rebound. Yes, the economy will rebound. But you have a certain demographic of the population that, quite frankly, can't afford the rest that are being charged in a lot of markets. Yeah. And I've had this debate with many people, even some of my partners, and I say, the market, once we resolve the absorption issue, we absorb all these additional units, it should be fine. I said, okay, well, tell me this. If you charge for somebody $1,000 a month today and they can't pay it, what makes you think just because there's less supply that you can charge them $1,100 and miraculously they're going to be able to pay it? And it's a problem that I'm seeing in a lot of markets. And I think that a lot of people are going to rush into C-class properties. And even when they buy them, it looks to be a discount. I think they're going to have a lot of struggles more than they're expecting. So I want to stay away from that going forward unless it's a really deep discount. So for me, it's better properties, appropriately priced. One of the things I've really been focusing heavily on for the last year and a half is building lender relationships because I've been hoping to capitalize on some of these distressed deals. I haven't done that yet, but it's something I have in the pipeline and kind of on the goal list for 25 and hopefully 26 and 27.
Yeah.
I think the story right now is buying at a good cost basis and finding something that cash flows right out the gate. Even if it's not great cash flow, at least if it's positive cash flow and it gives you time to ride the market back up, I think that's going to be very important.
I definitely agree with you there. Yeah, we're definitely in a very interesting time in the market right now, Charles, and I think that we're kind of like, I think that people are something that I've heard a lot actually is different operators who are learning right now or who are adjusting or modifying their strategies in real time, because now that we're kind of faced with the reality that like, hey, we're coming into a new cycle. We might not be at the very bottom yet, but we're coming into a new cycle. And so, to your point though, I think focusing on higher quality assets at this point in time only pays higher dividends in the future because you're riding the wave up in this next cycle, right? So like the Class A property is going to appreciate, at a faster rate, in my opinion, right, than say like a Class C property in this next upcycle. Would you agree or not?
I would. And part of the reason for that is just the buyer pool. Yeah, so you're dealing with a buyer pool that consists of larger buyers. Depending on how big of an A-class asset, it might even be something that you have an institutional buyer pool. So if you have that, you'd be surprised. Sometimes those things you really appreciate faster than any of us think because some of those groups will get very aggressive on pricing.
Yeah.
And they can. They have a cheaper cost of capital. So sometimes it works for them.
Correct. A lot of those guys, they're just focused on capital protection more than capital growth, right? So it's,
right.
I definitely hear what you're saying. And the same thing, in the hotel sector too. That's, what I have mostly, participated in up until this point is like the Class A, like the branded Marriotts and Hiltons in the tier 1 cities. Those are the ones that that the institutions buy, and they might not be, they're expensive, right? They might not be these cash cows, like say extended stay in a tier 2 market, but there's less risk involved,
right,
for them, right? And so they're like, hey, this is gonna be a steady hotel for us, instead of like potential like home run potential strikeout. So
yeah,
that's that.
I think that's a good way to put it. And what I would say is, in real estate in general, I think the more singles and doubles you can hit, the better off you are. While it's nice to go for the home run, sometimes what happens when you go for the home run is you strike out. And commercial real estate, that can be very expensive. So you want to try and minimize your strikeouts.
Yep.
And if you can keep hitting singles and doubles, eventually you're gonna score.
Agreed. Definitely agreed. So let's talk about your deal structure, right? I understand that you probably, are you syndicating these deals? Are you do you have a fund? Like, kind of walk me through what that looks like.
So all 11 of the deals that I've done in the past have been syndicated. We'll had, money from both the GP team and the LPs in there. Our early deals were just a very simple 70-30 split. They typically had a 7% preferred return, and they were pretty straightforward. Some of our more recent ones included an extra hurdle where at a 16% IRR, it would change to a 50-50 split. Going forward, I would also change it. So one of the things I want to do going forward, and part of the reason that I'm changing the asset class that I look at, is I want to start attracting bigger check writers. And I want what they would refer to as like programmatic equity. So it could be an institution. Well, truthfully, I'm probably too small to really be attracted to an institution at this point, but it could be a family office. There's one family office I've had a relationship with that they've cut a pref equity check for my most recent deal. So I'd love to be dealing with groups like that on a more regular basis. It's a different type of equity. It's a different type of structure. And some ways it can be more rich because they're going to have a lot more control than somebody who's just investing $50,000 in it. But there's also a lot more protections because, generally those guys, they're vetting these investors pretty well. So you have extra set of eyes on you aside from your own. And, you have a partner who, if things go wrong and there's a solid reason and a solid plan in place to correct it, that they understand. And they'll provide additional capital to get through that frame. So a lot of these groups right now, they understand market conditions have changed a lot in the last 3 years. So, it's not to say that they're writing checks just to reserve, those deals at no cost. But if they see that there's a real path forward, then they are writing checks for groups they partner with to make sure those deals can stay afloat.
Yeah, that makes sense to me. And so the way that you plan on structuring then is like maybe different share classes, right? So you're going to have different share classes with different economics for larger check writers.
Right.
Yeah, that makes sense. And let's talk about the most recent acquisition, right? Like, what's the most recent acquisition that you've done?
So most recent was a 168 deal in the Atlanta market. That we closed in August of 23. And what I liked about it is that it had a great loan assumption. So at the time we closed, it had a little more than 7 years left on the term. It was a Fannie Mae loan. It was actually two loans, a senior and a supplemental loan. And they had a blended rate of 3.79. So that was very attractive.
Yeah. So what was the LTV like, on the purchase though, like how much debt was left and is that where you used the pref equity then? Is you filled the stack with the pref equity?
Yeah. So what we did there is we were able to get it. So the debt, even with the assumption, was 73% LTV of the purchase price.
Oh,
then
wow.
The pref came in and the pref put in another $1.5 million. So that we still have another, 2.5 or so of common equity beneath that.
Interesting. Wow. So 73% LTV on the debt already. That's pretty good. I'm assuming then the sponsor sold it at a discount. They sold it for less than they bought it for.
They actually did okay because they bought in 2020. So I think one thing people don't understand is how much property values increased from 2020 to 2021.
Yeah.
So most groups who bought in 2020 should probably be okay because they had a tremendous increase in that one year. And without actually looking it up, I feel fairly confident in saying that 2020 to 2021 is probably the largest year-over-year increase in U.S. property values in history. It was absurd. And even early 21, I think a lot of them are probably okay. It was really like the mid to back half of 2021 where pricing started getting very aggressive and deals just didn't make sense for conventional financing. So a lot of groups started looking at them short-term floating rate financing. And those ones are probably very overpriced, along with anything wood in 22. So I would say that those guys did okay. They bought in September of 2020. They probably even got a little bit of a discount because there was still a lot of fear in the market at that time. The pandemic had started in March officially. There were rumblings of it even in February. And as soon as the pandemic hit, it froze the financial markets. It froze the transaction market. So there were a lot of people who just didn't know what was going to happen. And because of that, some of them were taking discounts on loan properties. So they bought this property in September 2020 for like $8 million and change. They sold it to us in August of 23, so just about 3 years, for $13.4 million. So they probably did okay on that.
Mm-hmm. Gotcha. Well, then okay, I'm just trying to do the math in my head then. How did they have debt? Did they refinance then? Is that what happened? They did a refi?
No, so what happened is with Fannie Mae, they allowed you to get what's called supplemental financing. And with supplemental, what that is, it's a second loan that's issued by the same originator who originated the first loan. Yeah. And it has the same maturity date, same expiration of the interest only. Only thing that's different is it's actually a second mortgage and they give you a higher interest rate because of that. So as long as the properties financially support that, they'll allow you to do that.
I see. Would that be like construction loan or something like that?
Well, it's really based on the property's financials and how well it's performing. So the property was performing well enough that they were able to do this. And the purpose of that loan is that it allows you to pull out some of the equity that's already in there.
Yep.
I mean, there's a lot of purposes, but that's what they used it for, is they pulled out some of the equity they had in there, returned it to their investors, and that way, it had less skin in the game.
Yep. That makes sense. I mean, it definitely boosts the returns at that point, right? Especially the IRR, right? Like if you can return some of that capital early.
Yep.
So I understand that. Interesting, man. So, and that's actually something that I think a lot of people maybe underestimate on the acquisition portion, or when you're looking at a deal, is there are deals out there with assumable loans. Right. And, those assumable loans are, that's a massive win for your investors, because the cash flows are significantly higher when you're factoring in a 3.79 blended rate, versus what you would have gotten, which is probably like 7.25, 7.5.
Not quite that high, but if you were getting a new loan then, and even now, like the Fannie Mae or Freddie Mac side, you'd probably be able to see like 5.5 and 6. And that fluctuates a little bit depending on, exactly when you close, but somewhere in that range generally. Now, if you're financing with a bank, then in that case, banks are a little bit higher, so you probably would be in like the mid to high 6s. But Fannie and Freddie give you decent charge, but definitely not the 3.9 that you would have seen a few years ago. Yeah.
I guess the rates are a little bit different in the multifamily sector than they are in the hotel world. I don't know anyone getting getting high fives right now, man.
Well, the big difference there is just that Fannie and Freddie provide liquidity, and they usually do it at pretty decent terms. So I think that's really key to it. Unfortunately for the hotel world, they don't have that luxury of using Fannie and Freddie. So and I think hotel finance also is dried up in general, just because there's been so much fear of, similar to multi, I'm sure you can relate. Hotels have had their own debt issues. But the only difference, I think, is that multifamily is kind of forced to keep lending because of Fannie and Freddie, where banks can just put the brakes on it and say, nope, we want to let the hotel deals fail before we finance new ones.
Let's talk about, because we kind of glossed over it, right? And Charles, I think you seem like the kind of guy that would be comfortable sharing. Obviously, the last couple of years have been difficult. What's one deal that didn't really go according to plan? Did you have a deal that didn't go according to plan? And what did you do to adjust or rectify it?
Well, let me just shoot straight. I mean, unfortunately, all four of the deals that I did with short-term floating rate debt, none of those went according to plan, unfortunately, because we closed on all between March and May of 2022, so 4 deals in a 3-month span. And pretty much after we closed all of them, interest rates started rising a lot. and then everything else kind of changed with it. So I'll give one example, the only one that's actually finished, because the others were still in. So the one that finished, what we did there is we decided to cut the loss and we sold it in September of 2023. And the date, that's the only one I have, a loss on my track record on it. There's still some that are pending. We'll see how they work out that, we don't really know what the results will be yet. But with that one, we realized, and thankfully we had partners on it who also realized, because sometimes partners can have different opinions. But in that one, I think we had a similar consensus that the market had changed substantially since we were gotten in that deal. It was going to be very tough to get people their money back or to make profit, but profit wasn't really even a thought at that point. It was more principal preservation. Yep. And we had an opportunity to sell it at a price that would give people like 90 to 95% of their money back. And you know what? While that's not the goal, you know what? It's a lot better than some deals are going to have. And we decided to cut the loss and move on and say, you know what? We want to make people money, but at this point, it's more important not to lose their money. And if we can get them 90 to 95% back of what they put in, even though it's not 100%, it's a lot better than what could happen if we hold this thing another year. Yeah. And that's a great story, man. And I think that there's a lot of sponsors out there that would be lucky. They would feel lucky if that happened to them, because and I'm sure that you're seeing this right now, Charles. Like right now, there's a birth movement of these debt funds. Yep. You know where I'm going with this. The debt funds that it's the same sponsors that did a bunch of deals in 21 and 22, and then now they're raising a debt fund. And what they don't tell you is that those debt funds are going to cover their ass on the properties that are failing right now. Right. And so we're going to put a Band-Aid on a bullet hole, and raise more investor capital so that we don't lose this investor capital. But ultimately, it's kind of like, it's like putting a Band-Aid on a bullet hole, right? So it is. And that's the reality. And sometimes, even if there is a real path to getting people money back, in most cases, it's a very slim path, very slim chance. But even if there is a real chance, it's probably not going to happen in 2 or 3 years. You're going to hold that thing another 7, 8, 9, 10 years.
Yes.
So, you really need to think what's better. And that's a very personal question, because if you have 50 or 100 investors in some of these deals, some of them may say, cut the loss and move on. Other ones may say, I don't care if it takes 10 more years to get my money back.
Mm-hmm.
So there's got to be a lot of different opinions. I think any sponsor needs to really think about what's in the best interest of the investors, what's in the best interest of really everybody. And do you have the time and the cash to keep feeding it until that happens? Because that may take some time.
What's different about this cycle versus 08, 09? Meaning, because here's where I have some issues. There's some people that say, you should partner up with sponsors with, multiple cycles worth of experience, which I agree with, by the way. But I also don't think that we've seen a market like this before. So even those people with that experience wouldn't necessarily have seen the warning signs for this iteration of distress. So I'm curious, what makes this different, and what you're seeing.
The only thing I would say that makes it different, I think there's more market manipulation now than there was in the past. Mm-hmm. The fundamentals are the same, but even though the underlying root cause is different, in my opinion, the issue that we have here is the same that we had in 2007 and 2008, and it was caused by greed. When times are good, sometimes people forget the fundamentals. Sometimes they stray awry, and they think good times are going to last forever, and they make poor decisions because of that. I think that was common to 2007, 8, 9, and now. I think the underlying reasons are different, but I think it comes out to human emotion. And I think that, people don't respect market cycles, or maybe they think they're immune to market cycles, which is great until you're the swimmer that's out there swimming with the current, and then all of a sudden it turns against you. Mm-hmm. Yeah. And I think that's what happened here. So I'll use myself as an example because I can't speak for anybody else, and I'm not going to pretend to know what somebody else is thinking. Sometimes I struggle to know what I'm thinking. But I'll give you 2 examples, and it's always clearer in hindsight, right? In August of 2021, I remember one instance. It was a Friday night, and I was going to a Carolina Panthers preseason football game with with a broker that I'm friends with. Yeah. And I actually
tickets like $5 or something.
It worked out well. I got it for free. They were better. So as we're walking to the stadium, I was joking around with them. I said, I see a lot of people who are a lot smarter than me selling their entire portfolios right now. I said, does that mean this is a bad time to buy? And he said, well, no, not really. And then I said, but you were a broker. You wouldn't tell me anyway, would you? and I kind of saw the writing on the wall with that, because I'm saying, all these big groups are selling their entire portfolios. That can't be by accident. Mm-hmm. And then the following month, September of 2021, the smoking gun. That was the very month I noticed, and I look at a lot of deals, it was the very month I noticed that Fannie Mae and Freddie Mac were no longer sizing anything to max leverage. Now let's be clear. So for anybody listening, especially if you're on the newer side, there's never going to be any point in the cycle where every deal is getting max leverage, because some of them just aren't going to qualify. Sure. It's a function of price. It's a function of the property's income. But when none of them are qualifying to max leverage, that's telling you things are overpriced. Right. And I asked myself that question that month. I said, does this mean everything's overpriced? And in retrospect, the answer to that question is yes. So while I went out and bought some new deals after that, in hindsight, what I've learned from that, and when I kind of knew, but it reinforced it for as long as I live, is that once conventional financing no longer becomes available at reasonable rates of leverage, it's time to slam the brakes on. Yeah. Go take 2 years off, sit on a beach, let the market collapse, come back in and do it again. Yeah. Mm-hmm. That's the point to be selling. So you want to be getting out of any deals that you had, and you want to be letting the market start to correct. So the single biggest thing in commercial real estate, regardless of asset class, is debt. Like people say location. And for residential real estate, I think there's probably truth to that. Commercial, location's important. Debt's a lot more important. So follow the capital markets, because that'll give you a good indication of what's going to be happening in the real estate market on the commercial side.
Mm-hmm. Well, speaking of debt, the latest special servicing report showed there's some pretty crazy numbers out there right now. We're looking at double digits pretty much in every asset class, double digit special servicing rates. And then, the delinquencies are, I don't know when the last time they've been this high. I mean, it must have been 08, 09. I don't even have that data, but we're at a point right now, Charles, where if the banks, like if they wanted it to happen, or if they couldn't hold on anymore, like it would be a total collapse of the commercial real estate sector. But like we're just not there yet. We just haven't seen it, and it's so bizarre. And I know that we talked about this earlier in the episode, but I just cannot get over the fact that like it just feels like we are one Jenga pull away, right? Like,
we are. I think that's a good way to sum it up. And I think the other thing to keep in mind is that even though we haven't had a massive collapse, there have been significant drops in valuations in multiple assets.
Sure.
So just let's be clear, because I don't know who the listeners are. So there are certain commercial real estate asset classes that aren't going to be as negatively impacted. But
correct.
Hotels, multifamily, office, new construction, all four of those are going to have, and have had already, pretty substantial impacts. And there'll probably still be more of an impact to come.
Well, speaking of hotels, right? And yeah, I'm sure you seem like you're really read up. So even though it's not your niche per se, like I'm sure that you know a lot about it, probably more than I do. But what I've noticed is that the sellers are being very unrealistic with their pricing. And we're seeing some hotels trade. They're trading for a lot more than they should sell for. Like the ones that I'm seeing sell, at least on the open market, the prices don't make any sense to me. I'm like, why would anyone? This is a waste of money.
I've seen that. Is like relate.
What's that?
I've seen that in multifamily too. So I can relate.
Yeah, you just kind of sit there and you're like, that doesn't make any sense to me. Now, presumably a lot, because these are, larger, higher brand, higher tier brand, Marriott, Hilton, tier 1, tier 2 city. So, these are perhaps institutional buyers like we talked about before that really don't care. But there are some hoteliers who are hotel owners that need to sell, but they are still not being realistic with their pricing. And the market hasn't caught up to their expectation, but the lender also is not forcing the sale.
Right.
So they're just kind of sitting there in purgatory. Right.
Yeah.
And of course, like they don't want to, who wants to sell for less than you bought it for, which some of these guys might have to do. But it's an interesting time, man. It's just a really, really interesting time. I think, I sit here and noodled on it for a long time. Yeah.
I totally agree with you. I'm going to give you a different word. So yes, a lot of the values are unrealistic. I'm going to give you a different word to supplement why they're unrealistic in many cases. And that word is hopeful. There's a lot of hoping and praying that they can sell these deals and somehow find that unicorn buyer is going to come through and say,
Yep.
So 1 out of every 1,000, maybe you'll find that buyer and that seller response will get off and have had a miracle.
Yep.
But the other 999, unfortunately, that's probably not going to happen. And their endings aren't going to reach happy. And it's exactly what you said, though. The catalyst is got to be the lender saying, that's it. I'm not going to extend anymore.
Correct.
And you need that to happen. So as that starts happening more, that's going to force some of these deals. And truthfully, at least in multifamily, I can't say the same. The Finney and Fleet hotels, I feel pretty confident saying this for office also. A lot of them aren't even worth the debt balance. And like when I see guys going in there buying deals for the debt balance, do I think they'll make money on these deals? I do, because I think that if they hold them 3, 4, 5 years, the market will have rebounded enough, they'll probably do okay with them. Do I think they make sense fundamentally? No. I think they're bad deals. I think they'll still make money with these deals in spite of being bad deals. But I think it's going to be that we'll see capital coming back into the market and it's kind of swimming with the tide versus against it. So even if it may not have been a perfect deal or a fundamentally sound deal, it'll still probably be a deal that makes money because all of a sudden the tide's got to change at some point. And now it's going to be working with you as opposed to against you.
Bring up a really valid point, which is, something like, buying, we're acquiring directly from the lender, or, we're buying it at debt cost, like we're buying it at debt cost, right? Like these are things that like a sponsor could use as like a marketing tactic, right? Like to make it sound like a great deal. But you bring up an excellent point, which is just because you're buying it for a quote unquote discount doesn't mean that it doesn't make it a good deal. Right. So that's interesting that you bring that up, because I think it's an excellent point. And especially right now, I think people got to be really, really careful, right? About what they're invested in. Speaking of investors, Charles, and I know we're running up on time here, so we'll have a couple of last minute questions here and then get you out of here. Where are you finding? This is a selfish question. I'm asking you, Danny question. I'm just curious where you're finding your investors.
So, admittedly, capital raising has always been the weak point that I have in my game, which is usually why I partner with people who are stronger in that. But if I was going to do it myself, if I was looking for like retail investors, like people that are going to invest $50,000 or $100,000 in deals, the way I would do it is really LinkedIn direct messaging. I think that's a great way to do it. In many ways, I tend to be old-fashioned. I like in-person events, but the challenge is when you go to a real estate conference, and conferences in the industry that many of us go to, when there's other real estate people like us. The truth is you will find some people there, because a lot of operators tend to be investors themselves. And in that regard, it can be a good spot. But I like to see spots where I'm the only real estate person in the room versus one of like 500 real estate people.
Yeah. Very true.
I would try to find cottages with other professions where you can stand out and get people's attention and build relationships versus other people who are doing the same thing you are. But LinkedIn direct messaging to me is a great way. Going forward, I also want to be attending different conferences. So I want to be attending conferences where there's what they call allocators, and those are in bigger check writers, family offices, institutions. Because in a room like that, I would absolutely be a small fish, but that's the money I want to attract going forward. And being able to get in those rooms and get face-to-face with some of those groups, that's where I think I'll have the most success during.
Makes a lot of sense to me. And I would be doing the same thing if I were in your position, right? Like ultimately, I think capital allocators, going to those larger check writers, it takes a longer time to build those relationships. But once you've built the relationship, it makes your job a lot easier, right? than going the retail route. Charles, this has been amazing, man. You are a wealth of knowledge. I have a feeling this won't be the last time we have a conversation, man. I enjoyed our talk a lot.
I do, and I look forward to having many more.
Yeah, absolutely. But you're not off the hook yet, man. Because in traditional Gould Mine fashion, we're going to have you leave the audience with one final gold nugget. Take it away.
Okay, so the gold nugget's going to be one we touched on in the episode, but I'll put it here at the end to emphasize it.
Boom.
Even though we're not at the bottom of the cycle yet, we are coming up on that in many of these asset classes in the next 6 to 12 months. If you haven't started getting ready, start getting ready. If you have started getting ready, get your butt off the ground and put it in motion, because it's time to get out there and get active.
Love it. Love it, man. I couldn't agree more. So, Charles, thanks for stopping by, man. And look forward to having you on again soon.
Danny, thank you.
Awesome.